Let's take a look at the criticism that's been given to the central bank to try and overhaul the financial system. What do you make of these moves? Because most analysts and investors seem pretty happy that we've seen such massive changes in the financial system.
Well, for us, we see these changes as welcome developments. One in particular being the instruction that interest rates, lending rates, and in effect deposit rates should be tied to the MPR rates. What we see from that would be that there will be more transparency in pricing of customer rates, and at the same time, it will give the central bank more leeway to adjust interest rates to the levels they feel are desirable for the economy.
We also had, of course, the central bank and the SEC planning to roll out a new set of regulations for banks regarding margin loans. Banks will now have a cap of 10% of exposure to margin lending. Obviously, quite a good move to try and mitigate risk.
Well, I think at this stage, it's what needs to be done. In the long run, eventually, we hope that banks would be able to self-regulate themselves and would, in their own internal processes, have these risk limits which they'd adhere to. But unfortunately, at this point, based on what we saw in the past years, most of these banks had not set the self-regulatory limits within their internal policy frameworks. And for that, I think the central bank is doing the right thing by instructing this has to be done. But like I said, in the long run, we hope that these things would be done by the banks by themselves and won't have to wait for the regulator to tell them what limits they have to set. Because at the end of the day, if you have a competent bank with competent policies and framework, they should be able to take decisions as to what level of risk they can take based on their resources.
Looking at the inflation rate, currently at 11.8% in March, it's the lowest number that we've seen since November last year. Some are concerned that with the new budget imminent, and of course that's going to be signed in relatively soon, that's going to have a negative effect on money supply. Are you of that thought as well? In other words, we'll be seeing an increase in inflation going forward because of the budget?
Well, I think by now, if there was going to be a significant increase, we should have seen it by now. Because if you recall, in the last 4 or 5 months, we've seen excess funds in the system, which is why we're seeing interest rates at all-time lows of 2, and on the 20-year curve, we're seeing rates at about 7%. So that excess in funds has come into the system months ago. And to some extent, we've not seen that expectation that there'll be a ballooning in the interest rate. On the contrary, like you said, we've seen a slight stop. Now, I think, in my own opinion, I don't expect to see a significant rise. Yes, I do agree with the prognosis that there might be slight rises in inflation rates in the coming months, but I don't expect to see anything really significant on the basis of money supply, because as we are, there's so much liquidity in the system now, and if that was going to happen, it should have happened by now.
Well, you mentioned a lot of liquidity in the system right now. So do you think that most corporates out there should be taking advantage of this excess liquidity and also just keeping in mind in terms of the cost of capital right now? Do you think that it's a wise time to get into debt for these big corporate companies?
Yes. Well, I think my view is that we still might see a slight drop in interest rates, but in the long run, as a corporate, my advice would be, yes, you should take advantage of this right now. In the last weeks, we saw Lagos State raise their 7-year bond at levels of about 10%. And this was on the basis of the fact that there was excess liquidity. The bond was heavily oversubscribed. And what you'd find is lots of banks are looking for places to put their funds, and once you're a corporate with good credit risk, this is a good time. In fact, my advice is to lock in for long-tenured bonds at this point and take advantage of the drop in rates.
Well, the central bank lending rates at 8% at the stage, and the borrowing rates sitting at 1%. The central bank governor, Lemido Sanusi, also talking about banks keeping interest rates relatively high because they were looking for profits and what he called unrealistic profits. Do you think that scenario is going to be changing going forward, given that when we look at Kenya, we've been seeing quite a few banks coming to the fore and dropping those interest rates?
Yes, I do. One of the things central bank had said is that banks would be a bit more transparent in the sense that their lending rates should be tied to the MPR rate, and they would have to report back to the central bank explaining the spread above the MPR rate in terms of what part is their margin, what part is the credit premium, what part is the liquidity premium, and so on. What we see is that a few banks might be a bit embarrassed by the figures they might come out with in terms of the spread above the MPR rate, especially when they compare to their deposit rates, considering that we could see some banks showing lending as high as 16 to 17% spread over MPR, while their deposit rates are 1 to 2% below the MPR rate. What we expect is that with this transparency, customers will be able to negotiate better. And again, with the central bank watching and asking questions, the era where banks could dictate wherever they're going to lend is coming to a quick end. And I think it's a good thing. And I think, yes, in the long run, we expect to see rates drop slightly. Clearly, if I was a customer, what this does to me is that I would be able to benchmark the pricing I'm getting from my bank to the risk, to the comparable risk of other companies, and I'd be able to ask questions to my bank to say, why are you putting this such risk premium on my business considering the standing of my business? So yes, we think it will push down rates in the long run.
Sola, we're seeing inflation looking much better. Of course, as I mentioned, the budget signing being quite imminent at the end of the day. More regulations coming to the fore. We also heard of a 500 billion naira infrastructure spend package going forward as well. How is this going to impact the naira?
Well, as is now, the excess liquidity we're seeing in the system is definitely creating interest for offshore investment. We've seen requests from the investor public as to what other alternative investments are there offshore. I think further liquidity into the system would just make that interest a bit higher than it is right now. So the risk would be a possible pressure on the naira in terms of a depreciation, because what you'd see is that funds that previously should have been in naira-denominated assets would start to look for opportunities in foreign currency assets, which would put demand on the exchange and further pressure on the naira. So I think in this low interest rate regime, and where you're seeing that deposit rates are significantly below where the inflation rate is, there might be some interest both in foreign currency assets and probably in the equity side of investment too.